Hello everyone. Today we are going to look at how different regions see things differently. But let's first take a step back in time, back to 2014, when the UK Financial Service Authority banned the sales of AT1 bonds or CoCos to retail investors. Why did they do that? Well, because these instruments are too complex and that retail investors are often unable to fully understand the risks involved. Because these products, which have a coupon and a maturity like bonds, are special animals. They were created after the financial crisis and their purpose is to stabilize bank capital in terms of stress. So as a result, it means that the issuer can convert them into shares or even cash when they have financial difficulties. And this risk is the easiest one to understand because there are other risks, especially legal ones, that require an in-depth reading of hundreds of pages of prospectus, which are not always very easy to grasp. Fast forward now 10 years to today, 2024. The issue is still the same. The misunderstood risks associated with CoCo bonds, but this time it's the Australian Regulation Authority, the APRA, that is considering banning these instruments, not for central investors, but from its market. According to APRA, these instruments are not fulfilling their stabilizing role because of their complexity, potential legal challenges and the risk of contagions in times of stress. While the Australian case is quite unique because of the unusually high proportion of CoCos held by retail investors, it is still making headlines. The Credit Suisse case shocked the financial world when the FINMA exercised its option to order the write-off of 16 billion Swiss francs of Credit Suisse CoCos. That was a first for the CoCo market and is a very Swiss-specific, as most European structures have conversion clauses into shares or cash. The Credit Suisse shockwave caused the CoCo market to drop by 15% in March 23. It has since recovered with the index up almost 40% since that low. And issuers are riding the wave. Buying back their existing issues. We're talking here almost $4.5 billion this year at mid-September, which is a record compared to 1.8 peak in 2022. And they are also issuing new AT1s on better terms. By mid-September 24, 221 new CoCos had issued issued, already exceeding the levels of the full last 2 years. But is this only a question of demand? Well, not quite, because the European Banking Authority, the EBA, has also helped by clarifying certain rules. Until recently, when issuers bought back part of their CoCos, the remainder in circulation lost its regulatory capital status. It thus became normal debt, but with very high cost. Since April, the EBA has confirmed that the balances retained their status, paving the way for partial buybacks and new issues. So this approach differs markedly from Australia's, which of course has its own specific reason. And to the potential question of which is the better, the question is simple: it depends. The main thing to remember is that the greatest risk you can take is not knowing how to identify and understand the risk you're taking. Thank you.